Hello, good afternoon, good evening. You're welcome to my channel. Welcome to my channel. Welcome to my channel. Alright, this is Judo Bingazika. I teach accounting tutorial. That's my daughter. She's greeting. Dada, dada, dada. Alright, today I'll be talking about a very important accounting topic, which is the double entry principle. Okay, I give accounting lecture. I provide accounting services, both personal and home tutorial and online tutorial. If you need any of these services, holla at your baby girl. Holla. Alright, let's drop right into it. Now, double entry principle is a very important topic in accounting. It's the basis for which accounts are being prepared. I would say it's one of the bedrock of accounting. Now, what does this principle say? This principle says that for every corresponding debit entry, for every debit entry, there must be a corresponding credit entry. Now, let's do the simplified manner. Now, double entry principle, just like the word says, double entry. It means that every transaction is recorded twice. Double. Okay? Every transaction is recorded twice. One is recorded on the debit side of one account, another one is recorded on the credit side of another account. So, for double entry to take place, there must be two accounts. In fact, there will be a transaction. That's the first thing that would occur. Now, when a transaction has occurred, you have to record that transaction. That transaction will be recorded in two accounts. I've talked about transactions, but let me just recap a bit of it so that we can understand how we're going to apply it in this particular scenario. Now, a transaction is simply exchange of goods and services for for money. So if for instance I want to buy a pair of shoe, I go to the market and I have a pair of shoe that I want to buy. I go to the shop of the seller and say, "Hey, Randy, I want to buy a shoe." And then he gets my size. Long story short, I'm paying for the shoe. The shoe costs 5,000 naira. Now, a transaction has occurred. Why? Because I have received the shoe that I want, which is the goods, and in exchange for that goods, I have paid money. A transaction has occurred. Now, once a transaction occurs, two accounts are going to be opened. And that is why you must understand types of accounts and understand how to interpret transactions. If you know how to interpret transactions, you will know the accounts to open. And then you solve the problem halfway. The next thing is now to know which account to debit, which account to credit. I have explained earlier on to account to debit, account to credit, but for this class, I'll give a recap. Now, the accounts that normally are debited accounts or are debit entry are your assets accounts and your expense accounts. Those accounts are debit accounts, meaning once there's a new asset or a new expense, you're going to record that transaction on the debit side of your account. And when you say debit, you mean left side of the account. That is exactly what debit means. And I've explained what an account is. But account normally is something that is a T shape, left side and right. Just like when you have your letter T. You draw a letter T, you know you have a horizontal line and a vertical line, right? That line divides it into two sides, left and right. The left is debit, the right is credit. Simple as that. Capiche? Okay, so now let's get back into the issue of shoe. So now I've bought a shoe. I want to interpret this transaction. That's the next thing I want to do. So that I can know the accounts to open. Excuse me, sorry about that. Now, I have done a purchase. By virtue of going to the market to buy shoes, I've done a purchase. Now, if Mr. Randy we're talking about Mr. Randy now, is the one that has the account that I want to open, is one that would want to record his transaction, that wants to know, okay, who and who bought what from me. So, because Randy is in the business of selling shoe, that shoe that he sold is part of his inventory. Are we together? Now, we are going to have our purchased account. I, Ngozi, came to Mr. Randy's shop to do what? To purchase a pair of shoes. So, which account do you think will be affected? We have purchase account, option A. We have inventory account, option B. We have cash account, option C. Which account do you think would be affected? Now, the account that will be affected is your purchase account and your cash account. One might say inventory accounts. Now, inventory account, there's not really a thing as inventory account per se, because the purchase that was done is linked to the inventory. So that covers inventory. Are we together? So we'll be left with purchase account and our cash account. Why? Because I paid cash for it. If I told Mr. Randy that please, I don't have this money, I'll pay you later. And for me to make such a request, there should be a relationship. Either I've been buying shoes for Mr. Randy for a very long time, and so he doesn't mind giving me shoe on credit. Are we together? So that is that. So I have my purchase account, and then I will have my cash account. Now, cash account is an asset account. Are we together? Is an asset account, and I'm taking money out of my purse and I'm giving the money to who? Giving the money to whom? To Mr. Randy. Now, because I am the customer who bought that shoe for who bought that shoe for Mr. Randy, and I'm opening Randy's account. Now, Randy, what happened now for Randy is that he made a sales, whereby if it was my own account I was talking about, it would be that I made a purchase account. So since we're talking about Randy's account, the account that will be recorded will be sales account and customer account. Whereby if it were me that was recording what have happened, I'll be having a purchase account and I'll also have a cash account. So because it is Randy account, it's going to be a different, there will be different accounts that will be affected. The ones I mentioned earlier on were the ones that will be affected if it was my account, not Randy account. Okay, so let me get that correction. So Randy is the one recorded now. Randy made a sales, right? So I have definitely a sales account. Who bought the product? Ngozi bought the product. Okay, did I pay via cash? Yes, I paid via cash. So you're going to have sales account. I must stop putting that in your mouth. You're going to have sales account and then cash account. Are we together? Why? Because Randy made a sales. So you must always interpret the transaction first of all. Now, the next thing you ask yourself, who is recording the transaction? Is it is it Randy or me? If you notice, when I gave the earlier instance of me purchase and then cash account, that was the instance that I was the one recording it in my own account. Because if it's in my own account, what I did was I made a purchase. I didn't do a sale. But for Randy did a sale. So you must always understand the transaction and understand whose account are you recording. So if you're recording for Randy, we'll have two accounts. Hope we're getting something out of this video. You will have a sales account because Randy made the sales. You also have a cash account. Why? Because I paid with cash. So now we've sorted out the issue of the accounts to be open. We have our sales account, we have our cash account. That is if Randy is recording this transaction. Okay? Now, I said earlier on that expenses and inventory. Expenses are assets, are debit entries. Why equity? Okay? Equity meaning capital. Equity, revenue, liabilities are credit entry. Meaning, whenever you have these transactions, the first place you're going to record them are credit entries. So, if you're able to know the classes of accounts and where you post them, some are debit entry and some are credit entry. That is why you must be able to classify if you're able to know the accounts you're opening, then classify them. Is this an asset? Is this an expense? Is this a liability? Is this, so you're able to know which class does it belong to. Now, sales is revenue, and revenue is income. So because it's income, we record it where? On the credit side. On the where? On the credit side. Remember, I said credits and revenue, income and liability are, sorry, revenue, which is same thing as, okay, revenue, income, liability, revenue, which is same thing as your income account, okay, because revenue means inflow, income coming in, okay. Liability and equity. These three are credit entries. While expenses and assets are what? Debit entry. So now we've interpreted the transaction, we know the accounts that are affected, and we know which accounts will be debited, which account will be credited. Okay, based on my previous video, I explained how to record, and I recapped it right now when I was explaining that debit entries are assets and expenses, while the other three are for credit entries. Are we together? So now I'm going to debit our cash account. Cash account is an asset account. What kind of asset is it? Is it current or non-current? If you listen to my previous videos, I explained types of assets, and one of the types of asset we have is cash, and cash is a current account. So I'm going to debit my cash account, and I'll now credit my sales account. That is, on the left side of my cash account, I'm going to put 5,000 naira. While on the credit side of my sales account, which is the right side, I'm going to put 5,000 naira. So if you see now, same amount is being recorded on both sides of the account. It's just that I'm having two accounts. That's the double entry. So I'm recording what happened two times. One in sales account, the other in the cash account. Are we together? That's the double entry. I've recorded what transpired two times, twice, or you both that twice. I recorded the transaction twice, debit side and credit side. I have fulfilled it. Now, in our accounts normally, I explain what account looks like, the description. Check my video to understand what it is. But let me give you a recap. Accounts has a name, date, description of particulars, and amount. So you have this thing on both the left side and on the right side. Now when it comes to description, or rather, dates. So first of all, you have your date, particular, and amount. Those are the things that you have. Particulars, date, particulars, and amount. Are we together? So if, for instance, this purchase I went to the market happened on the 17th of May, it means on the date I will have 17/5/2025. Now, the particulars will be the corresponding entry. The corresponding entry account. Okay? And that account is what? My cash account. So on that particular account, I'm writing which account did I do the next account. Did I post the second transaction? Same transaction, which account did I post it the second time? And that is my cash account. So under description, I will have cash account, and the amount is what? 5,000 naira. I have recorded on my sales account. I will go to my cash account and record also. I will say date 17th, particulars is sales account, because that's the corresponding account, and the amount is 5,000 naira. So this is how you record your transactions, basically using our double entry principle. I hope we've learned something. Hope we've learned something from this. That I brought it out. I'm doing a video. That is, I'm not responding. I brought it out already. Hope we've learned something. So if I were to record this transaction for myself, let's say I am recording it as per I have an account and I want to keep record of my expenses. I'm going to have purchase account and I will have cash account because I made a purchase. Are we together? Now, purchase account is an expense. For me, it's an expense. I've incurred expense. Are we together? So I will have purchase account and I'll have cash account. Now, because purchase is an expense, yes, when you purchase something, you have expended money. Are we together? So I'll go to my purchase account, and then on the debit side, because it's an expense, it's on the debit side. Are we together? On the debit side, I'll have 5,000 naira. Date will be 17th May. The corresponding particular will be cash account, and the amount is 5,000 naira. Are we together? Then in my cash account, because I have expensed money, money has left me. Are we together? Because money have left me, I'm going to credit my cash account. Remember, I said cash account is a debit entry account. That is when you have inflow of cash. Are we together? But once an outflow of cash is going to be the reverse. Are we together? So same thing with your asset account and other accounts. Whenever it is an inflow of that particular account, you're going to record it the way it ought to be, whether it's debit or credit, the way it is original, like I said earlier on. That is how you record it. So for assets, you're going to debit it. But if the asset is reducing, if you have like disposal, for instance, you will do the reverse. You're going to credit that asset account. Do you understand? So same here with your cash. Cash normally is a debit account. I would have debited it if I was receiving cash. But because I'm expending cash, cash is leaving my pocket, leaving my business, leaving wherever. But the important thing that cash is leaving, you will now credit it. Are we together? So the thing with double entry principle is that for every account, they follow the rule like I said earlier on. Assets and expenses are debit, but when there's a decrease in those things, you're now going to credit. Do you understand? While income, revenue, liabilities, and equity are credit entry, meaning once there's an inflow in this account, in these three accounts, you're going to credit, but it is an outflow, you're going to debit. Hope you're not getting confused but understanding. All right, so we'll stop here. This is a typical example of a double entry principle of our transaction, and I hope we've learned what I taught. Let me do a recap. I talked about what double entry is. I gave an instance of me purchasing shoes from Randy, okay, and then I explained the transaction, which led us to know the types of accounts to open. Because we knew the accounts open, we knew which were supposed to be debited and which were to be credited. And like I said earlier on, accounts that are debit entry, once there is a reversal, once there's a decrease in those accounts, you're going to do the reverse. Hope it's not getting confusing. All right, so stick with me. I would explain further, giving further examples, just in case this is not clear. But I believe you've learned something at least. You've understood what double entry principle means. You know what the transaction is. You know the accounts to be opened. You know which accounts to debit, which accounts to credit, and when there will be a reversal of debit and credit. Hope you've learned something. Share this video to your loved one. I'm so happy to be here. I want to thank you so very much for taking our time to listen. I believe you've learned something. If you've learned something, please give my video a like. Come on, give it a like. Subscribe and hit that bell so anyway you know when I post new videos. Thank you. Bye.